Good day, everyone. Thank you for joining us once again here at Seaford and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we would just want to highlight a couple of charts that are kind of cautionary in terms of where we might be heading in terms of GDP and potential recession. We're not saying that this is going to happen over the next 12 months, but we do see some trends in the data that's been coming out that we need to bring to the surface and start looking at and analyze. First off, and we've gone through this before, when we're looking at the economic expansions between 1945 and 2009, we can see that the average expansion lasted about 58.4 months. The longest expansion was 120 months, and that was between 1991 and 2001, the dot-com phase. Currently, in our current expansion, we're at 102 plus months in here, so we're slowly getting to that 120 mark. Next July is when we would hit the 120. So we want to keep an eye on how we're progressing through this period. When we look at some of the charts in the monetary policy report that came out last week, we start to see some trends, and this is a report. We're not going to cover the whole thing, just a selection of the charts. But I encourage everyone to go out to the Fed's website, download it, and read through it. It's a very good read. First, let's look at the unemployment rate gap. Now, this is the difference between the actual unemployment rate and the Congressional Budget Office natural rate that they set. So this is the difference. Now, I can see is currently we are below zero. So we're lower. Our 4.1% is lower than what the Congressional Budget Office would indicate as natural unemployment level. And notice that when we go back to the prior recessions, there is a trend in here that we dip below their rate prior to a recession. So just keep that in mind. That's one of the warning signs that we have out there, that we need to start looking at this a little more closely. Another thing we want to look at is the job availability in hard to fill positions. This could be an indication of a potential recession, as well as a rise in the overall cost of wages. And as you can see, we tend to peak out here if we look back to the prior recessions right before a recession hits. So we want to keep an eye on this as well when we start to see this coming off. And we have a little bit of that happening on the hard to fill, not so much on the job availability. So we still have some time. And again, these are just cautionary signs that we want to look at. Also, when we look at the equity side, we can see that this CAPE ratio versus long-term rates. And the CAPE ratio is simply just a 10-year real adjusted PE ratio. So when we look at this going back into history, back to 1880, we can see that we hit a high of 32.56 back in 1929. The highest in history we've hit in 2000 at 44.3. Remember, this was the end of the dot-com. And then currently we are at 33.41. So you can see a trend here where we're starting to hit highs. Interestingly, when we correlate this with the overall level of stock returns using the S&P 500, you can see just after we hit the high here in 29, we saw 4 years of negative returns in the stock market, according to the S&P 500. 2000, the end of the dot-com, you can see we hit another 3 years of consecutive negative returns in the stock market. So here we are today at 33.41. We continue to have one of the longest stretches here in terms of annual growth, annual returns in the S&P. So we naturally have to think, how much higher can this go before we start to see this reversal? We've had some volatility in the market over the past couple of weeks, and that's going to be natural, but nothing that is to the tune of annual losses. So just something to keep an eye on as we move throughout 2018 into 2019 and 2020. Changing now from that growth prospect in terms of GDP to the inflation question. As you can see, this is another chart from the Monetary Policy Report. We have seen a little bit of an uptick in the overall inflation year over year is starting to happen. We're still below that 2% Fed target, but we do have an upward momentum over the past several quarters. When we look at the measure of hourly compensation, again, we start to see an upward trend overall in here, with the exception of maybe the Atlanta Fed's growth tracker, which kind of fell off latter part of 2017 and started to pick up a little more as we come into 2018. So we see overall price inflation starting to pick up for goods and services, and then we start to see this wage inflation begin to pick up as well. Lastly, we'll look at the median inflation expectations. So this is what people anticipate the inflation to be going forward. And you can see throughout 2018, fairly flat. Even when we come back, we have to go back all the way back to 2012 when it was a little higher, but at that 2%. When we look at the Michigan survey of expectations, you can see there's overall a downward trend throughout this time period. But we do have a little bit of volatility picking up a little bit most recently, but overall it has come down. That being said, we have mixed signals inside of the different indicators that are coming out in terms of inflation, but what we need is consistency. If we consistently see the inflation numbers ramping up, that is an indication. It could pop up one quarter and drop down another the next quarter, but what we want to see to be sure that inflation is truly headed up, we need to see the consistency month over month and quarter over quarter in terms of the overall trajectory that we can anticipate. But this, expectations kind of staying where they have been so far. That's what we have for you today, kind of almost a preview to next week's webcast, where we have a bunch of data coming out this week, and we have a lot of data coming out next week as well. When we come back next week, we'll talk about a second estimate of the GDP, as well as in the inflationary numbers that have been coming out, and the PCE, core PCE, that comes out later this week. We look forward to seeing you here next week. Have a great week, everyone.